From 0% interest rates to zero deals. Commercial real estate got slammed in under 12 months. And here's the thing, it wasn't just because rates went up. Let's take a look at what really happened. First, the Fed didn't just raise rates in 2022, they hit the market with a sledgehammer. From March 2022 to the middle of 2023, the federal funds rate soared from near 0% to over 5.5%. It was the fastest and most aggressive hiking cycle in over 40 years.
The expected interest rate hike comes as everything from gas and food to air travel have seen the largest annual increase in nearly 40 years.
For commercial real estate investors, that was a death blow to deal flow. Why? Because debt pricing doubled, sometimes tripled. Loans that were underwritten at 3% interest rates were now coming back at 6 to 7%, and sometimes even more depending on the asset and location. Sellers were still holding on to 2021 valuations. And buyers? They were there, but they were seeing a completely different world. Cap rates couldn't expand fast enough to keep up with the cost of capital, and that created a frozen market. The bid-ask spread not only widened, it blew wide open, and transactions dried up almost overnight. But here's the key point most people miss. Interest rates didn't cause the fragility. They exposed it. They exposed how over-leveraged many investors were, how thin some underwriting had become, how dependent pricing had become on free, easy, abundant capital. Deals didn't stop penciling just because rates went up. They stopped penciling because many only made sense in an artificial zero-rate environment, and that era ended in a matter of months. Secondly, the office sector didn't collapse just because interest rates went up. It collapsed because demand dropped permanently. Before 2020, dense urban office space was seen as essential. But by 2022, the entire psychology of work had changed. Remote and hybrid work weren't temporary, they became embedded in corporate culture. And suddenly, companies realized they didn't need 10 floors of Class A office space anymore. They needed flexibility, so they downsized. They subleased. They just walked away.
Well, David, Los Angeles may be a smaller office market than Manhattan, which we talk about so much, but it has even bigger problems. The office vacancy rate in LA soared to 22.5% in the first quarter, compared with Manhattan at 17%. This represents 50 million square feet of empty offices, about 61% more than pre-pandemic. LA office leasing volume in Q1 was very low.
Even with landlords offering months of free rent, turnkey TI packages, and aggressive concessions, tenants didn't bite. Not because the space wasn't nice, but because they didn't need it. Vacancy skyrocketed, sublease space hit all-time highs, landlords were holding obsolete inventory, and asset values in some urban cores, they didn't just drop, they collapsed. 40, 50, even 70% declines on some Class B and commodity assets. Why? Because these buildings weren't just temporarily vacant, they were functionally obsolete in this new work paradigm. This isn't a typical down cycle. It's not about waiting for a rebound. This is a structural reset, a secular repricing of an entire asset class. And it's forcing investors to ask, what is office space really worth in a world where half the workforce never goes back into work? Number 3, multifamily was the golden child during COVID. While retail and office were on the ropes, apartments were booming.
If you ever thought living in a cool apartment in the East Village or a fancy high-rise on the Upper East Side was out of your reach, you may want to think again. That's because right now there are thousands and thousands of empty apartments, and yes,
migration to the Sunbelt spiked, remote workers relocated, and rents skyrocketed 10, 15, even 20% year over year in some markets. Cap rates compressed into the 3s. Everyone wanted in. Institutional capital poured into the multifamily sector. Developers broke ground at record pace, and buyers underwrote deals assuming endless rent growth and zero vacancies. But by late 2022, reality hit. Renter affordability had reached its breaking point. Demand had cooled. Rent growth has now slowed, and in many markets it started to reverse itself. At the same time, expenses surged. Insurance premiums, payroll, repairs, and property taxes all spiked. And to make matters worse, a tsunami of new supply, especially in Sunbelt markets like Austin, Phoenix, and Atlanta, started to hit the market all at once. Suddenly, value-add deals didn't look so valuable. Buyers who purchased at peak pricing with short-term floating rate debt and little cash flow buffer found themselves underwater and underwater quickly. Debt services doubled, net incomes didn't move, and refinances not happening. This correction wasn't just about rates rising, it was about assumptions being wrong. Aggressive projections, thin margins, and fear of missing out fueled acquisitions are now being punished by the reality of operating fundamentals. Number 4, even industrial and retail, commercial real estate's post-COVID golden children started to show cracks by late 22 and into 23. Let's start with industrial. The sector was on fire through the pandemic. E-commerce demand soared, vacancy hit record lows below 3.5% nationally, and rents grew by double digits in places like Inland Empire, Dallas, and Atlanta. By 2023, tenant demand started to cool. U.S. industrial net absorption in 23 was down 60% from 22, and the national vacancy rate crept back up to 5.6%. Still healthy, but rising fast. The real drag? Big box space. The 500,000 plus square foot distribution centers built for Amazon-style logistics were suddenly oversupplied. Amazon alone cut over 40 planned facilities and put multiple warehouses up for sublease. It wasn't just rates, it was overbuilding and a slowdown in an e-commerce growth post-pandemic. Now, retail was more nuanced. Some segments thrived. Grocery, anchored centers, QSRs, and experiential retail, think fitness, med spas, and dining, those actually outperformed expectations. Foot traffic returned and in-person spending came roaring back. But Class B and C shopping centers, especially those without anchor tenants or with a weaker credit inline tenant mix, they struggled. According to Green Sheet, Class B mall values are down over 50% from its peak, and many are functionally obsolete. So while rates impacted cap rates and financing, these slowdowns weren't just about interest expense, they were about reality setting in, saturation, shifting consumer behavior, and finally, a return to what really matters: tenant quality, location, and sustainable demand. Here's the truth. Cheap money, it covered up a lot of bad deals. From 2020 to 2022, interest rates were near 0%. That made it easy to borrow, easy to buy, and easy to believe everything would just be okay and keep going up. But when the Fed started raising rates and raising rates fast, the cracks started to show. And not just because debt got expensive. Office buildings dropped in value because people stopped needing space, not just because interest rates went up. Multifamily deals failed because rent growth slowed and costs jumped, not just because interest rates went up. Even industrial and retail, which were hot for years, cooled off once demand slowed and tenants got harder to find. This wasn't just about interest rates going up. Rates were the spark, but the fire was already there. It was years of easy money, aggressive assumptions, and the belief that values only go one direction. Rising rates didn't cause the collapse. All they did is expose how fragile the foundation had become. Office demand was already changing. Rent growth in multifamily had already peaked. Industrial, it was already overbuilt, and retail was already splitting between winners and losers. So what's the real lesson here? This was never just about the cost of debt. It was about what happens when the music stops and the fundamentals finally matter again. So here's the bottom line. To win in commercial real estate, it's not about timing the Fed. It's about understanding the fundamentals. Since 2022, we've learned that when the easy money disappears, only one thing matters: the strength of the asset itself. Interest rates didn't kill deals on their own. They just exposed the ones built on shaky ground. Office demand didn't collapse because of the cost of capital. It collapsed because of the need for the space changed. Multifamily didn't just struggle because interest rates went up. It struggled because rents stopped growing and costs kept climbing. Here's what actually wins in commercial real estate. First, assets in markets with real sustainable demand. Second, creditworthy tenants with long-term staying power. Third, cash flow that stands up, even if interest rates stay high or go higher. Because the biggest lessons from the last 2 years is this: it's not the rate that makes or breaks the deal, it's the real estate.